All right. All right. All right. Welcome. Welcome to the David Carmena show. And I am still in the office. Guys, I am going to do a nightly segment on kind of the day's events and how they relate to us business people. You know, we go through the day, and there's a lot of things that happen in that day or in the previous days where um, it's reported, but it doesn't really report on how it affects us. How that event affects us as an investor, particularly a real estate investor or an entrepreneur, just someone in business. We covered the bank crisis and the bank failures, and we've done that a lot on our previous streams, but we didn't really dive deep into a particular issue and how that particular issue affected us as a real estate investor or as a business professional in the black and brown community, or maybe you're just starting up. Maybe it's an opportunity for you to see how that will affect your positions, your bottom line, your day to day. So, on a regular basis, we're going to dive deep into a single or a couple of different topics that happen in that day and and have a prolonged discussion about that. Just recently, we've had several historic events where not only the one of the largest or the largest bank failure happened with SVB, but then right behind its heels, we have now First Republic Bank. You know, when SVB went down, over and the Fed hopped in and they said that okay, we are going to cover everybody. We're going to make sure that all depositors, hey, brother, hey, Chris is here. Let me put him up there. But we're going to make sure that all depositors uh, come to the platform, and we're going to make sure that they're covered not only to the FDC insured rate, which is 250,000, but then also to any deposit over that amount. We're going to cover this. We're going to cover it. Fed came in and Yellen came in and said, "Hey, listen, we got you. We got you. Don't worry about it. Your money is safe." They did that so that they could have make sure that there wasn't a bank run and make sure that people did not rush and pull out all their money, causing a systemic bank failure. Okay, so that's what they did. Now, we thought that for a day or so, we thought that hey, everything's good, just that one bank failure, and Chase saw that First Republic Bank. They saw that that bank was in trouble, and so Chase gave a crazy amount, like $31 billion, to help a loan to help that bank become solvent. Now, well, we have First Republic Bank. They decided that the Fed decided that that bank is in trouble, and so I'm going to play the tape. I'm going to play this report, and then we're going to go back and see if there are any other banks that are in trouble, or if we can stop stop the contagion in with just the acquisition of First Republic Bank. Here we go.
The U.S. government seized First Republic Bank on May 1st and struck a deal to sell the bulk of its operations to J.P. Morgan. Regulators hope the move will head off a chaotic collapse that could reignite the banking crisis.
No way.
Ben Eisen covers banking and finance for the Journal. He explains how First Republic became the second largest bank to fail in the U.S. and what it means for customers, investors, and the industry.
First Republic had this business model that was just sort of perfectly built for a certain time period. When interest rates were really low, the bank collected a lot of deposits, that made a lot of mortgages. But when rates suddenly shifted last year, the bank's business model started to look a little bit more precarious. After Silicon Valley Bank and Signature failed in March, everyone pretty much immediately started looking to First Republic as the next risky bank in the system. Silicon Valley Bank and First Republic, they had similar enough client bases and similar enough risks and problems that investors and customers and really anyone eyeing this banking crisis started to kind of lump them together. Some of the biggest banks collected $30 billion worth of their own money, and they deposited it at First Republic Bank, basically trying to make up for the deposits that customers had pulled. It was helpful for a day, but it didn't stop the panic. Coming into April 24th, First Republic was already in a pretty bad spot. After the bank released its earnings and really didn't impress people with what it showed, you had this period of time where the stock was falling really rapidly. There was a sense that this bank was increasingly at risk of being seized. Early in the morning of May 1st, an announcement came out that JP Morgan would be buying First Republic Bank. This was a deal that was orchestrated by the Federal Deposit Insurance Corp. When the FDIC conducts this process to sell a bank that it's seizing, it's basically looking for the best bid. And in the deal, JP Morgan will be taking on some $92 billion in deposits from First Republic, buying a lot of assets, including the bank's loans and bonds. Shareholders will get wiped out. This is a deal that will effectively allow First Republic to live on as a part of JP Morgan.
Let me be very clear. While depositors are being protected, shareholders are losing their investments. And critically, taxpayers are not the ones that are on the hook.
The resolution for First Republic appears to be the end of this stage of the banking crisis. That said, the problems that kind of led to this crisis haven't necessarily been resolved. Interest rates rose really quickly. The value of assets on banks' balance sheets fell a lot. It doesn't appear that anything's imminent at this moment, but I think a lot of people would be hesitant to say this is over.
All right. So what happened there? First Republic Bank went first. Let's give a little context, a little history. First, there was SVB, First Republic Bank. They went down, and Chase bought the bank for $11 billion. $11 billion. Now, the word on the street is that it was supposed to have a lot more bidders for the bank, and that there were other players in there. But I think that because frankly, because Chase gave that $31 billion before, that they allowed them to now buy that the assets of First Republic for only $11 billion. Now, I want to ask you guys, if $11 billion and you buying the second largest bank failure in the United States history, was that a good deal? Was that a good deal for Chase? Was that an opportunity for Chase to do a favor, or was that an opportunity for Chase to do a cash grab? I want to say to you that it was a little bit of both. It was a little bit of both. You had, Chris says, no, first I want to acknowledge Christopher William, thank you. Thank you for the super chat. You know, you have been a friend to the channel. You were on the last collab that I did with AV, Tim, the Intentional Millionaire, Perry Unlikely, and Sim about a week ago or so when we covered SVB Bank. And I want to again thank you for your $1.99 super chat. I really appreciate you. Any support that you give content creators like us, and I've seen you on other channels, so any support that you give content creators is a value, and I appreciate you, brother. Thank you so much. In Allen, thank you, In Allen, for coming to the chat. You know, you did your midnight review last night of true stories for a pharmacist. I enjoyed it, and really, to be honest with you, In Allen, that was what caused me to decide to do something like this. And I think that I will, because I find that look, guys, I am a full-time business. I have multiple businesses. I'm a multi-million-dollar producing broker. I am in real estate for real. And yet I still want to share my thoughts on how day's events affect us as investors and potentially can help you save money on that bottom line. So, I saw Ellen just last night with her show, and going in fact, I want to invite everyone to go to her channel, and it's right up there, Ellen RX. She's a great content creator and part of the lead attorneys mastermind. But she did a show last night, and I said, wow, I'm a night owl. I'm always in the office, and that's why my the name of this segment is going to be Still in the Office, because I'm in the office downtown, and I want to kind of recap on my thought for the day. Thank you again, Christopher. So, Alan, thank you for coming to this chat. I appreciate you. And you said that it sounds like a money grab, and you're right. You're right. It was a money grab. Now he went out there. The CEO of Chase went out there on several interviews, and he basically said that he believed in the banking structure. He believed in the sovereignty of smaller banks, and we should have smaller banks. We should have regional banks. We should have banks that kind of focus in on a certain segment of the banking population. Example, SVB Bank was a bank out of Silicon Valley Bank, SVB, and they focus mainly on startup tech companies, that type of thing. And that's why they said that, well, for Silicon Valley Bank, it was unique. The bank failure was unique because the banking structure, the business, the customers, the depositors for that bank, well, they were startup companies, and they had significantly larger deposits than $250,000. Okay, that is what was sold to us, guys. That was the message that was sold to us, and sure enough, we bought it. I bought it. I got to admit, I was like, okay, the Biden administration, the whole banking structure, they caught it in time. They make sure that all of the other banks, they did a review. Remember, they did that internal review. The Fed chair just came out and said that he did a review of his involvement in the that contributed toward the bank failure, and we're good. We're good now. Sure enough, a couple of days later, now we're talking about First Republic Bank. So yeah, Alan, it was a cash grab. It was a cash grab. Okay, so 10 Plus Sound, they bought it on sale. Absolutely. $11 billion for a again, second largest bank failure. That's a sale. $11 billion to us is a lot of money, but when you have trillions in asset, when you're Chase and you bank and you have, one of I think they're number one. I know that Bank of America is in there, and they're definitely part of the top 5. When you have that much money under assets, and you only have to spend $11 billion to buy another bank, to buy all of their deposits, that's on sale. That's a discount. That is a discount. So 10 Plus Sounds, I agree with you. Now, Alan laughing at me. Why are you doing that, Alan? Shout out to the team, the No Sleep team. That's right. I am still in the office. I'm still in the office, guys. We just came out of a mastermind, and I want to shout out to the lead attorney. If you guys are a YouTuber or want to be a YouTuber, his course is of value. He has 2 courses. One is for beginners YouTubes to kind of get you introduced to YouTubing. And then the second course is a little bit more advanced. But I think that course those 2 courses are great to help you be a professional YouTuber. How did startups have so much money in the beginning? Great question. Great question. Okay, and if you have any questions about the SVB or the First Republic first the Signature Bank one, as well as the one that just failed. If you have any questions about that, just put it in the chat. I'll answer it. Okay, so here's what happens with Silicon Valley Bank in Allen. I think that's what you're referring to. How did startup have so much money in the beginning? Yes, angel investors, as well as larger loans. Let me back up. Yes, that's the sound effect I want here. Let's go back in time. Let's talk about how companies get money. A startup company gets money in a couple of different ways. First, what they do is that there's some traditional ways, and then there's other ways. And I'm talking generalities, guys. This is entertainment purposes, but I do have a 30-year, 20+ year career of a multi-million-dollar business, and so I wish that I knew how to get money at this time. And in fact, I'm gonna let you guys in on something. I'm gonna really let you guys in on something right after I get this super chat. Thank you, brother. Real Bravado Network. Thank you for the 20 spot. I appreciate you, brother. You are the stream sponsor. I'm gonna put you in there. Thank you, thank you, thank you. Salute, salute, salute. Thank you for that 20 spot. I appreciate you. I appreciate you for that. I'm gonna get you down. In fact, let me do it right now, because you guys know I am bad on banners. I'm horrible. I'm horrible on banners, so I'm gonna do it right now. Let me get this. And I'm gonna create a banner. Real Bravado Network. For the 20 spot. Sponsor. Let me do the scroll. All right. All right. And let me add a couple of things here. All right. Add you back. And let's do this. Back to banners. And let's show this. All right. There we go. Thank you, Real Bravado, for the 20 spot. Okay. Now, how do banks, let's going back to N. Allen, how do banks get their money? And especially when you're a startup. Now, for traditional banking, let's say banking with the top 5, we're not talking about credit unions. We're not talking about those other ways of, you basically need 2 years of experience. You need 2 years of being in business. So they look at your last 2 years. You show that you're making money, and typically you get money from a traditional bank. However, if you can show a proof of concept on an idea, so let's say you have a really good business plan, you have something innovative, especially if it's innovative, guys. If it is novel, if it is in a trend, let's say you're doing something in green energy, let's say you're doing, hate to see it, the current administration, you're doing something that aligns with what their goals are, then there's money out there for that. You have development funds, you have angel investors, you have, if you're doing green energy, there's green banks that actually fund projects on green energy. So let's say you're starting up, you have this great idea, and you go and say, hey, listen, I want to, my company is, we've devised a way that we can harness water and produce clean energy from water. And actually, that's been studied, but it hasn't been brought to a commercial stage because it's not cost effective. But let's say you do that, and it's still in the proof of concept phase. You was able to identify that this is viable, and you got this great business plan, and you say, okay, angel investor, I have this great business plan. I was able to do it on a smaller scale. I'm ready to bring it to the market, and I need $5 million. $5 million will allow me to have some research and development. It allows you to me to build the model out, to scale out, hire some people, bring people in my team. $5 million, and what I'm going to do is I'm going to give you. And here's my projections. In my projections, if we're successful, this company could be in 5 years a $500 million company. Okay. And I'll give you 10% of my company or X% of my company if you give me that working capital. Well, to an angel investor, that is, that's a good idea. And so they would say, okay, for 10% of your company, there's some haggling back and forth, but yeah, I can see that. I can see that. You got something that's working, and I can see that for 10% of your company, I'm going to give you $500. I mean, $5 million, but I have to be part of your board. I mean, they're going to put some strings on it. I have to be part of your board. My board's going to come in, and they're going to take a look at everything, and that's how they were able to. And this bank is friendly to me. This is a bank that SVB is a bank that I use. I'm an angel investor. I use them. I may have a line of credit with them, and I'm using their line of credit or my relationship with that bank. I'm leveraging it, and I'm going to give you that $5 million off of from there. Maybe my line of credit. Maybe I have a $20 million line of credit with the bank, because most of these guys don't use their own money, guys. Believe it or not, they don't use their own money. So I'm going to give you that money, and you're good to go. Okay. So now the bank is vulnerable. One is they have a line of credit out for the angel investor. And then two, they have a depositor that now has well over the insured amount. Okay. And that particular bank, SVB, they said was unique because they had all of these startup business or e-commerce business, tech businesses, all of these businesses has these very high deposits, and it wasn't like a community bank where you only have a couple of big players in there. They had a lot of big players in that particular bank, and that's why SVB went down. Okay, so when you hear about they're having unique, SVB was unique, that's what they're talking about. So did that answer your question? And Alan, just put something in the chat so that I can follow up on that. But let's go back to First Republic. That bank was another. They're trying to build it as another unique situation where the depositors was not as diversified, and that led to that bank being extremely at risk. But guys, to be honest with you, that bank has been the whispers on the street. I have a lot of financial people that I eat dinner with. Actually, it's a group of Morgan Stanley people. It's a group of I better not say no names, but they're a group of very high up executives. They have their own finance team. They may be a regional player. Let's say they're a regional player in the market. And so what they do is sit around, guys, and we sit around, and all they do is gossip about talk shop and gossip about banks, gossip about what's going on in the financial space, what to look for, and what do they think is being reported, and what is not being underreported. So actually, First Republic Bank was a bank that was on their radar for quite a while. In fact, they said that, David, you might want to take a look at this. Now, I was at dinner with them today. I eat at this club, and it's right across from my office. Really, I might take you guys there one day and let you see what it looks like a private club look like in the inside of your having. It's really cool. It really is cool. You go there. The food is decent, and it's a great way for people just to kind of unwind from the day and talk shop. But they said another bank that I'm not going to disclose tonight is in trouble. They said that they showed me the stock. They say, look at the stock, David. Look at this. Look at this bank. This may be another bank where the banking market is not as solid as we think. It may not be. And if it start a domino effect, if how many banks will chase by? How many banks will chase by? So if other banks start to fall, we may have a problem. We may have a problem. We already have QT, quantitative tightening. The Fed came out already and just the other day and said that, hey, listen, Chairman Powell said that I don't think that we're going into a recession. Okay. I think that the banking is stable and we kind of gotten past all of the turmoil. Well, okay. And for that reason, we only raised the interest rate by 25 basis points. So a quarter of a percentage. But in the same breath, he said, we have had a 500 basis point raise over, I think he said 18 months, which is unprecedentedly high. Okay. And so we went from a situation where the interest rate not too long ago, we talking last year, was in the threes. You can buy, a house and get a mortgage for bad credit, mid threes, good credit, low 3%, and and above. And that was really, 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 really good interest rates. Now that caused inflation to kind of go out of whack, but the interest rates was really affordable, and a lot of people were taking advantage of it. But now look at it. We're in interest rates upper six with good credit, even much higher with not so good credit. And all that is maybe directly related to Fed Chair Powell's policy of raising that interest rate, raising that 500 basis point raise over such a short period of time, causing these banks that was already had bad practices to go crazy. Let's see what the next question is. What happens to investors' dollars after the bank fails? Are they paid something, or is it all gone? Investors. Okay. Very good question. 10 plus sounds. Very good question. All right. So for SVB Bank, what happened is that the investors were on their own. Now the depositors. Are you saying investors, bank investors? People who own stock or people who had interest in that particular bank? Or are you talking about the depositors? I want to make sure we're clear. 10 plus. Go ahead and put in the chat which one it is. I'm going to assume that we're talking about investors and not depositors, because the depositors, they're good. Stock owners, good. Thank you, 10 plus. All right, so the stock owners were not bailed out. They were not bailed out. So bank officials, stock owners, investors, they were not bailed out. They lost their shirt. And unfortunately, it's kind of sad because you can have a bank to be on the board. You may have put in maybe millions of dollars of your own money to be part of this particular bank, and you were not saved. You were not bailed out. However, if you deposit money in the bank, no matter what amount you deposit, you were covered. You were covered because you did nothing wrong. You did nothing wrong. But those bank officials, the people who were over and in charge of the bank, they did their money. We think that the government and the Fed think that because of their strategy, because they tried to they manage the bank was not managed correctly, that you own your own. So it was not a traditional bailout. A lot of times for SBB, they said that, well, they bailed out the bank, and no, it wasn't. FDIC only protected the depositors. They did not protect the investors. So a lot of people lost a lot of money with SVB. I haven't read particularly about what with First Republic Bank, what happened. It was a little bit different because, like I said, Chase gave, I think the number is $31 billion before it went down, and then another $11 billion to take over the control of the bank and the depositors. So I don't know what happened to the investors of First Republic Bank. Okay. Any other questions that you guys have, I want you to just put it in the chat and I will answer it. But I want to pivot to, well, what happens with the Fed policy? Why did the Fed Chair Powell came out and only raised it 0.25 basis points, only raised the interest rate by 25 basis points? Well, Fed Chair had three options. He had three options available to him. He could have paused, meaning that not raise anything at all, raise the interest rate, and all the banks and everyone kind of banked in. The market was really it was really baked into their market analysis that he probably would raise it 25 basis points. Or he could pivot. Okay, now, you guys are going to hear a lot about pivoting. What he decided to do is the chair decided to raise the interest rate by 25 basis points, 0.25%. Now, what most people don't understand is that, or may not understand, is the workings of the chair. It's not like he just comes up and just say, okay, I'm going to do this. He has a committee. He works with a committee, and the committee puts out an opinion of what they're going to do, and it's a vote. I'm going to have a whole show on that, maybe another time, about how the Fed comes up with their policy, their monetary policy. I might do that a little bit later on. In fact, in the chat, guys, if you guys want me to talk about how the Fed comes up with their monetary policy, put a 1. If you say, I don't need to know that, put a 2 in the chat. 1 for you want to know more about the Fed monetary policy, and then 2 in the chat if it doesn't really matter. Fed comes out, it raises the monetary policy by 25 basis points, and the next, a lot of people think that thank you. It looks like we have a couple of people who want to know more, and I'll do a show on that. I'll do another show on that, and we're going to dig deep because it really is quite interesting how they come up with these policies. It really is. But the bottom line is that the market was prepared for the monetary policy, the Fed, to come up and do a 25 basis points, okay, a raise. So they was prepared for that. Okay, that's great. Everyone thinks in fact, I read one report, or heard one report, that there's an 80% chance that the next time the Fed come out and to talk about the policy, that he's going to pause. They're not going to raise it. They're going to just let it ride. Okay, that is based on a lot of data that they put together to decide this policy. But I tell you guys, if there's not a pause, if the Fed does not do anything, if he raises the interest rate by anything, then all hell is going to break loose. All hell is going to break loose because 80%, the market thinks that 80+% chance that there's going to be a pause in the raising of the interest rate. That's what everyone is banking on. And so if the Fed meets market expectation, no, we all good. We all good. But the Fed comes in and does not do something outside of what the market thinks the Fed is going to do, the market is going to react favorably to that. Okay? Very important to what the Fed does next time. And then a lot of us think that in fourth quarter 2023, so fourth quarter this year, the Fed is going to pivot. Now, what is pivot? In monetary terms, guys, put in the chat. What do you think that Fed pivoting means? What in finance? What do you think it happens when the Fed pivots? Because you hear a lot about when the Fed pivot, when we're going to pivot. Is there a pivot coming? You hear two words that's in the market right now: recession and pivoting. Okay, I don't see any response, so I'm going to go ahead and let you guys know. A pivot is when there's a change in their policy. Okay, they've had a policy of raising the interest rate. Everyone thinks that when they pivot, they're going to start lowering the interest rate. Now, Fed Chair Powell came out and said, hey, listen, we're not going to do that in 2023 at all. We're not doing that in 2023 at all. We're going to do, we're going to look at it. It's a month by month basis. And maybe in 2024, maybe we're going to, do something about maybe lowering the interest rate. With the goal of inflation, trying to get that inflation to 2%. Now, I don't know why they have 2% in their mind, but trying to get the inflation to 2% is their goal. Okay. So what does that happen? How does that information, how does it help us as a business owner? As a business owner, we got to think about access to capital. Or maybe you're not a business owner. Maybe you want to buy something, access to capital. Maybe you want to buy a house, or you want to buy, hopefully you're buying an investment property. Hopefully this is not the time to go out and buy pleasure unless you got it. If you got it, hey, listen, you can go out and buy that boat or that car or that second car or pleasure vehicles or something that don't make money for you. If you got it, hey, but if you don't have it and you are depending on working capital to run your business, it's going to be tough. It's going to be tough because the banks are tightening credit. The banks are tightening access to capital, I should say. And they're not going to change that. They may not change that monetary policy until at earliest fourth quarter this year, most likely first quarter of next year. Fourth quarter this year, first quarter 2024, when the Fed pivot and start lowering that interest rate. So if you're trying to buy a house and you say, well, I'll buy it, the interest rate, let's say the interest rate is 6.5% now, or 7%. Let's say 7% because it's an easy number. And you saying, well, I'll wait until the bank pivots. I'll wait till the interest rate goes down. Let's say that. Then you may be waiting until next year. So if you're in a situation where you're renting and you are renting at a rate of what's the, I guess most rents for a 3-bedroom, 2-bath. Let's say I'm going to start here in Tampa. If you're lucky to get it for in a decent area, if you might be paying $2,000 a month. And if you go all the way up where Randy is, hey Randy, I see you, girl. I see you. Randy, let me know what the interest rate is. I mean, if you rent, or you may know, in California. Randy's in California. Thank you for coming to the show. I appreciate you. Let me know what rent is there. Okay, I would imagine that a decent place to rent is probably going to be upward 350, 3,500 for or better. So if you're in a situation where you can buy, and you say, well, I want to wait till the interest rate fall until, let's say, fall from 6-7% to 5.5%. You want to have a 1.5% drop in interest rate. Guess what? You might be waiting a year. You might be waiting for you may not be able to purchase definitely in 2023. And so you may be waiting until 2024 before you can buy that house, first quarter, second quarter. So you have decisions. You have some decisions to make. The decision is that do I buy now and then refinance in a year, which may be the best option because you're not renting. At least you have a return on your investment if you buy a property, and then refinance when the rate goes down. So those. By knowing the monetary policy, by listening to your boy, you can make an informed decision. That's what we're all about here. Now, let's say you are a business leader and you have a business and you want to expand. Well, you need working capital. You might have an option of, well, how can I expand for I want to add a product. I want to add a service to my business. And let's say I need $200,000 to do that. And you want to go out and borrow the $200,000 from a lender. Well, now you know that if you're waiting for the lender to charge a certain interest rate on that money, because they got to make money too, well, you got to really look at, do I expand now in 2023? Or should I wait to expand in 2024? Or maybe there's a hybrid approach. Maybe I kind of start the process now with current staff, or I get a 1099 person in and don't give them the benefits of being full-time, and I bring them on full-time next year in 2024. Those are questions that you should be thinking about. And those are questions directly tied into your access to money. Your access to money. If you don't have cheap money or easy money, then that may affect your growth. That may affect the ability for you to scale. So what we do now, the policies that we cover, and the policies that we're going to be talking about tonight and other nights like tonight, I want to make sure that you guys challenge me to tie that policy into my business or my opportunities, because that's what I'm all about. I want to put those pieces together, put all the dots together to see how it's going to affect me, how that policy is going to affect me. If they change the policy, what happens? I'm assuming that you're talking about pivoting, Chris. If they when they pivot, what's going to happen is that the bank is going to lower their rate. They're going to probably, I'm going to guess they're going to probably do it in increments. It's not going to be a big drop. So maybe the first pivot will probably be something like 25 basis points. And then they're going to come back and they may do, depending on how the market is handling that, then they may do a 50 basis point pivot the next time they come out. And then maybe over a year, in 2024, they may reduce the basis points by 100. So 1%. And then they're going to see how inflation is and how the market handles that. And then they're going to base their policy on the market reactions to that policy. So they're gonna put a little bit out there first, and they're gonna say, okay, how, how's the market handling that? Okay, all right. No doom and gloom. Okay, all right. So I'm gonna do a little bit more the next time I come out. How's the inflation? What happening with that inflation? All right. I'm going to do a little bit more, and then before you know it, they may have dropped at 100 basis points, which is 1%, and the market, their target goal of inflation is down to, let's say, is down to 3% instead of 2%. Maybe that's acceptable over time, because there's other market factors that happens, guys. Like I said, there's QE and QT. There's other things that kind of happens in the market. There's core inflation. There's a lot of things that they look at to see. Thanks, Christopher. They look at to see how they're going to act the next time they come out and make this monetary policy. It's not. It's part of an art and part of science. They look at science, but then there's an art to it. It's an art to it. And there's a lot of players in making that art. So that's all I really want to talk to you guys about tonight. We have a great opportunity to kind of be informed. And if you are in business, in fact, in the chat or in comments, or shoot me an email, if you are in business or you thinking about buying or purchasing something, let me know, and then I'll kind of tailor my comments to your specific situation. And we can talk about how a policy or a procedure affect your situation. And, I won't use any direct information, so I'll just kind of use a generic your situation. We'll talk about that. We'll talk about how, is it a good time? Maybe it is a good time to, based on your circumstance, maybe it is a good time to purchase a home. Maybe there are other factors where purchasing that home makes sense. Or maybe you can wait till 2024 to purchase the home. So we're going to have these conversations. It's going to be real informal. I'm going to want you guys to ask the questions. And like I said, I am a 20-plus year real estate investor. I made engineering degree. I kind of made my money over through real estate, guys, to be quite frank with you. And so I have a unique perspective because I do this for day in and day out, and I want to make sure that this information is passed on so you guys can make informed decision. All right, so we covered First Republic Bank. Again, I said that maybe the word on the street is there's going to be something else maybe happening probably within 2 weeks. If it doesn't happen by the end of this month, it probably will not happen. So if this other shoe doesn't fall by the end of the month, it probably is not going to happen. And I'll let you guys know if it does. I'll keep an eye out on it. So, but First Republic Bank was taken over by Chase, $11 billion, got the job done. And from all accounts, with the market reacted to that. In fact, let me pull up the current. I think it was basically even today. Let me take a look at it. Look at the market here. Give me a sec. Let's see. Yeah, it was basically even. Dow is down 0.86%. Everything's under 1%. So S&P down 0.72, and then NASDAQ is down 0.49%. So and let me see the volume here. Yeah. So it's basically a basic day. So nothing crazy. And that is a testament to how well, relatively speaking, how well the First Republic Bank was done. Chase came in, swooped it. Hey, wrote that check for that $11 billion, and that was super smooth. I don't even think that anyone lost their job. So very well done. Let's see any more comments. Christopher, thank you so much for your super chat. I appreciate you, brother. I appreciate you. In Allen, we will be on the look for show. I'll be watching. I'll be waiting. All right. Let's see. 10 plus. They're probably cleaning their house to avoid any bankruptcy. So yeah, 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 probably, because if that particular bank is taken over, it's going to probably be one of the big five probably is going to buy that bank. It may not be Chase, because Chase is getting some flack for purchasing this First Republic Bank for only $11 billion. Okay, so it probably won't be. Oh no. But another bank, one of the big five, is probably going to buy that one. And my concern is that will that cause a bank run? That's the only concern. If it's handled where one of the big five come in and buy it, and then they can create a narrative. Because remember, the narrative was First Republic Bank and SVB the narrative is that, it's a unique situation. It's a unique situation. They
What they did was, it was unique, and they only happened to them. It wouldn't happen to anyone else.
but we don't know. We don't know if that's the true case. If they come in and there's another bank, and then there's another bank, and then there's another bank, wow, now we have a problem. There's probably going to be a bank run. And you think the inflation is high now, or you think that there's not good faith in the economy and the Biden administration, all hell is going to break loose. All hell is going to break loose. All right. Yep. 10 plus. There's a lot of unique situations. Yeah. They can't use that narrative going further. They really can't use that narrative going further. All right, guys. Thank you guys for coming in. I'm David Carmena. I am still in
the office. Thank you so much.
And I want you guys to again, this is a great way to kind of put all the pieces together. I want you to ask any questions as we talk about these topics, and I'll do my best to kind of interweave it into your daily life. And always, this is for entertainment purposes. I want you to like and subscribe to my channel. Like and subscribe. I always forget to say that. I always forget to say to like and subscribe. It means so much to me. Thank you for the stream sponsor, the Real Bravado Network. Thank you, brother. Thank you for the 20 spot. Thank you, guys. And as always, salute and stay grinding. I'll see you guys next time.